Thanks. In the introduction, you mentioned about the founding of ECP, which happened about 5 years ago. On slide 3, I've just given you a waterfall chart of where we're at. And as of this morning, and given the improvement of the markets, we're well over $2 billion that we're managing. And that's thanks to the team that I've got, but also the support of people like yourselves and others who knew me from my time at Hyperion. When one looks at the market, and you guys do this every day, so I don't mean to teach you all to suck eggs, but to quote the old expression. But really, if you look at the performance of the market, which I've highlighted on slide 4, if you're looking at outperformance, and these days people have these wonderful software programs that analyze risk, etc., and they tend to start from risk, which I think is the wrong way around. One needs to start at making some money for your clients and then adjust it for risk depending on what risks you see. But if you want to focus on the outperformance, clearly the smalls and mids was where the action has been in the last 10, and it's been the case forever. And in the period that I highlight there, which is 01 to 019, 68% of the time, the best performance was obtained by small caps and mid caps, which you guys all know because the bulk of your research is focused in that area. We've always said, and I've believed in, that if you want to be a successful active manager, and we hang our hat on, as you see at the top of the slide there, redefining active investing, because I think a lot of people have fallen by the wayside, you really, really need an information advantage. And we obtain the information advantage by the help that we get from networks, which include yourselves, and also obviously fundamental research. And having come from the broking side, that's where we cut our teeth, and that's where I believe the real money is made, is if you do decent forensic research. And we've broken our research process down into what we call the 6 pillars, which you can see on slide 6. And one of the recent additions resulting from some work by younger son who's in the team, Jason, who's currently studying for his PhD. It's into the sustainability of businesses, and that's a recent addition to our pillars. But that's how we look at companies, and when we talk to your analysts or we talk to companies, it's all around looking at those 6 pillars and getting a handle on those 6 parts of the business. The investment team has not changed since I last spoke to you. It's the same people, albeit a bit grayer and a bit longer in the tooth. I think most of them are known to you. And our investment philosophy is still the same as what it's ever been, that we're focusing on quality businesses that have the ability to grow. So our focus is on growth. And we always say we value the potential and not just the performance. So clearly historical performance is important to us because it proves the track record. And I always use the analogy of a cricket team. When you're picking the Aussie team, you pick the batsmen that have made centuries, not those that have made ducks that you always think can make a century. So we're talking about the performance that management and the business model have achieved over time. But then clearly it's all about the potential and where they're going. And that's the hard part, but that's where we get paid to do our work, and that's where we rely on some of the work that you guys do for us as well. Temporary turbulence in the markets, which we've seen over the past 2 months, is something certainly we think long term, and we think through the turbulence, and we use the turbulence to add to the performance of the portfolios, which I'll get to in a few minutes. So really the 2 things that we believe that we take advantage of is the growth anomaly in the market, and we believe that really high quality growth companies tend to be overvalued, and that we take advantage of the time arbitrage, which is the 5-year period that we look at, where we think that the market certainly looks sort of a couple of months out, maybe a year out, and that's where it stops. And if you think a little long term, you have a competitive advantage in the management space. The question to yourself that people like yourselves ask me and everybody else, and I've been talking a lot through the digital media, which we've all been doing, is how we've been handling COVID-19. And the fascinating part of all of this is those of you who are close to us know that we value and we construct our portfolios based on what we call the internal rate of return, which is really just a yield to maturity if you want to compare it to the bond markets. And as we got through Christmas last year and into January, our internal rate of return for the portfolio dropped to 10%, which is kind of like the lowest it ever gets to. And our construction process forces us to increase the cash, which goes to sort of close to 15% when the IRR hits 10. So leading into COVID, as a result of purely the way we do things and not necessarily some smart analysis by the team and myself, we were at really high levels of cash as we went into this COVID experience. And that then enabled us to deploy that cash when people were coming to the market and raising some capital, people like Cochlear, which we think is a great business. And we didn't necessarily think they needed the money, but they couldn't settle that lawsuit without raising some money. So we took some stock up. But we had plenty of cash to do that, which was really fantastic for us. And then in the middle of COVID, our internal rate of return was back up to close to 20%, which meant we had to be fully invested, and that's kind of what we did. So we had strong alpha generation during this period. Yesterday, I was given the final numbers for May, which really blew me away. And if you look at the disclosed NTAs, they also show that strong pattern. And just to put it into context, the 3 months around the whole COVID experience, Flagships was up slightly at 0.2. ECP, which is in the small cap space, and we delineate the two between X50. So anything that's in the X50 is in ECP. Anything that's bigger than a 400 million market cap is in Flagships. So there's some overlap there, obviously, but the primary focus of ECP is in the small to mid caps, whereas Flagships has got some bigger companies in the portfolio. So FSI was up 0.2, and it's a less volatile portfolio than the ECP, which we've seen over time. But ECP was up 10.6 over the quarter. And that's versus the all odds accumulation, which was down 9, and the small odds, which was down 1.9. So fabulous results through turbulent times. The important number for us and for you and your clients and those that invest in the two entities is the since inception numbers. And for ECP, which is the recent cab off the rank for us, the inception number is 15% versus the small odds accumulation of 6, which means alpha of 9.25, which for all intents and purposes, I think is pretty good. And I'm sure you will agree. Flagships has done, every time I've published this number, it's around 12 point something, 12.3, 12. It doesn't matter whether it's post-GFC, post-COVID. We don't obviously have numbers for the stock market crash in 87, but certainly things that I were managing had the same level of alpha, which compared to the all odds is about 4, and compared to the straight index is about 8. So good performance in all of those through really tough times. And if you pitch to people like Mercer and the rest of them, they always talk about the difference between luck and skill. And they start to think that you've got a bit of skill when you see really bad times like we did through the GFC and through COVID. But they also want to see you around for more than 5 years, which we've certainly been in the ECP model with the investment team that I've got now. The disclosure to the market yesterday showed the current major holdings, which had moved substantially during the month. By comparison, in ECP, SEEK is now the biggest at 5.7, but if you went back a month, it was Afterpay at close to 9. So we've been taking and I know it continues to strengthen, but in our RR process, we have seen the RR of that stock decline, so we've been selling a bit, but certainly the current weightings are, as you see on slide 12, with Rio Tinto, the dominant holding in Flagships, and SEEK the dominant at the moment in ECP. And the top 5 are shown there. And Afterpay is still in, obviously, the ECP top 5, but it's not number 1 like it was a month ago. Name changes to the portfolio. I'm always asked by you guys, what stocks have we bought or sold? Clearly, we can't talk about what we're thinking of buying. But since the start of the year, we've sold Fisher & Paykel and PushPay. Both of those on valuation issues, particularly Fisher & Paykel. Our internal rate of return actually went negative, and there was no way on this planet that we could continue to hold it. We've added IDP, which we've always liked as a business, but it was always far too expensive for us and the way we calculate our potential return from the stock. And during the COVID environment, obviously with students not coming to Australia, not traveling around the globe, that got absolutely hammered, and there was an opportunity for us to go in. So we've added that. We've added a couple of other small ones, Ordinate and Lifestyle to ECP, but mostly IDP was the only addition. Just to give you an example of how we do things, There's two cells that I've highlighted there. The one that I've spoken about, Fisher and Paykel, which was purely on valuation. So we still think it's a great business, but we don't think we're going to make any money out of it over our time frame, and which is, as I said, a 5-year time frame. So we sold out of it. We do sell when we think there's a major problem or there's a merger or a major acquisition. So Reliance, we bought at the float. We thought it was a fabulous business. The opportunities in the US were big. And then they bought John Guest in the UK, which was almost a similar sized business. And our rules dictate that if somebody acquires or there's a merger and acquisition of a company that's bigger than a third of the enterprise value, it's an automatic sell for us because there's always a lot of dust to settle. So we sold Reliance, and clearly when we think the dust has settled, we'll go back into that. But that's a forced sell for us. So if there's a major management change, like the CEO and financial director leave, it's immediate sell. If they change their business model, like happened with Westfield some years ago, it was an immediate sell. So we do have hard sells where you guys might look at us and Lisa might phone our desk and say, what the hell are you guys selling this for? But it's because there are hard things that we, in our process, have to adhere to. But outside of that, it's valuation based and what we think we're going to make out of the investment. The only thing that I would like to talk to is two things. One, the metrics around Flagships and ECP, they're both trading at a discount. And we've done a lot of work and tried various things with buybacks, et cetera, over the years. And with the investment performance, it only comes down to liquidity and clearly size. And over time, we are endeavoring to grow the size of both these entities. Flagships is a little difficult given the shareholding, but ECP, certainly we have now appointed Copia to help us with our distribution in the retail land, and we expect that discount to close, and then once that happens, we certainly will be looking to increase the shareholder base. But they're currently trading ECP at a bigger discount of 25%, given, I think, the space that it's in, and Flagships at about 16%. The dividend yield is the next bit, and I've shown you slides of the track record of the dividends that have been paid by both of these. And for me, the difference, essentially, besides the tax treatment between LICs and unit trusts, is the ability of the LICs to use reserves to either prop up or to increase the dividend. And I can't talk about what's going to happen with the next dividend because that's clearly a board decision. But I think that's a fundamental principle that differentiates between the two. So one would expect some kind of retention of dividend, not necessarily at the same levels if all dividends are not being paid, like you heard in the UK. But certainly that's something to be kept in the back of one's minds, that LICs do have reserves that they can draw on, whereas unit trusts every year they declare it out to the unit holders. As I said, the dividend yield is 4.8 in Flagships as it currently is, and ECP is a lot lower than that at 3.9%. Looking to the future, which is the question I always get, so I've tried to address it up front. Our modeling of the companies that we're in suggests that the internal rate of return is a little lower than 13% today, but it's around those levels. As I said, it has peaked at about 20, and the lowest has been about 10, with the median about 15, slightly lower than 15, 14 and a half, thereabouts. And if you look at the historical track record, we've kind of delivered on that. We've been close to that forecast in terms of what's actually happened. So it says that our forecasting tends to be reasonably correct, sometimes for different reasons. But at the moment, we think that we make about 13% compounded over the next 5 years on the investments that we've got. And if it's at 15, it means your money doubles every 5 years. So assuming no change to the discount, that should be what investors will look out for.